The stock market just crashed 870 points in a single day, and this time, it's not about interest rates or inflation. President Trump just threatened 8 of our closest allies with crippling tariffs, unless they help him take control of Greenland. The Dow plunged almost 2%. The S&P 500 had its worst day since October, and over $1.2 trillion in value just vanished from the market. European leaders are calling this the biggest transatlantic crisis in generations. Gold just smashed through $4,800 to hit a brand new all-time high, and your portfolio is likely taking a hit right now. But here's what most people are missing. This exact pattern happened 3 times last year, and every single time it created a massive buying opportunity. So in this video, I'm breaking down what actually happened with these Greenland tariffs, why markets are freaking out, what it means for your money, and most importantly, how you can position yourself to profit no matter what happens next. So let me walk you through exactly what went down this past weekend, because the details here are wild. On Saturday, President Trump posted on Truth Social that he's imposing a 10% tariff on 8 European countries starting February 1st, 2026. That's just days away. The countries getting hit are Denmark, the United Kingdom, France, Germany, Norway, Sweden, the Netherlands, and Finland. And Trump said, if a deal isn't reached for the complete and total purchase of Greenland by June 1st, those tariffs are jumping to 25%. Now you might be thinking, wait, what does Greenland have to do with tariffs on Europe? Well, Greenland is a self-governing territory that belongs to Denmark, which is a NATO ally. Trump wants to buy it. Denmark says it's not for sale. So Trump's response is to threaten their entire alliance with economic punishment until they hand it over. And he's not just going after Denmark. He's targeting 7 other European countries that participated in joint military exercises in Greenland. Trump called these exercises a very dangerous situation for the safety and security of our planet. European leaders fired back immediately. 8 countries issued a joint statement saying the tariff threats undermine transatlantic relations and risk a dangerous downward spiral. French President Emmanuel Macron said, no intimidation or threat will influence us, and that tariff threats are unacceptable. Denmark's foreign minister said, after meeting with our Secretary of State, that it's clear the president has this wish of conquering Greenland, but this is not in the interest of the kingdom. And that's when markets started melting down. Tuesday morning, European markets dropped over 1%. But then something interesting happened on Wednesday that completely flipped the script. Trump shows up at the World Economic Forum in Davos, Switzerland, and suddenly the tone shifts. First, during his speech at Davos, Trump says he's seeking immediate negotiations over Greenland, but then adds that he would not use military force to acquire the territory. That was a big change from his earlier statements, where he refused to rule out using the military. Then a few hours later, Trump drops a bombshell announcement. He posts on Truth Social that, based on a very productive meeting with NATO Secretary General Mark Rutte, they have formed the framework of a future deal with respect to Greenland and the entire Arctic region. And because of this understanding, he says he will not be imposing the tariffs that were scheduled to go into effect on February 1st. The market reaction was instant. Stocks shot up immediately after Trump posted that update. Now, in an interview with CNBC right after the announcement, Trump described this Greenland framework as pretty much the concept of a deal. When asked to confirm the tariffs were off, he said, no, we took that off because it looks like we have pretty much the concept of a deal. He called it a long-term deal, the ultimate long-term deal. But he wouldn't say whether the framework actually involves the U.S. acquiring Greenland. NATO put out a statement saying the framework will focus on ensuring Arctic security through collective efforts of allies, and that negotiations between Denmark, Greenland, and the United States will go forward, aimed at ensuring Russia and China never gain a foothold in Greenland. And if you've been paying attention to markets over the past year, this should feel very familiar. This is the exact same playbook we saw 3 times in 2025. Trump announces tariffs, markets crash, everyone panics. Then Trump pauses or delays the tariffs, and markets rally back. It happened with Mexico, Canada, and China. It happened again and again, and now it's happening with Europe and Greenland. Let me give you some context here because this pattern is critical to understand. In the beginning of 2025, we saw 3 separate market crashes. All 3 crashes happened because the Trump administration was imposing or threatening new tariffs. It started with tariffs on Mexico, Canada, and China, and then expanded from there. Every single time Trump announced these tariffs, the same thing happened. Markets had a knee-jerk reaction and fell hard. Then when Trump paused or delayed the tariffs, markets rallied and recovered. Then it happened again and again. Despite those 3 crashes, the markets in 2025 closed up more than 16% for the year. So those downturns ended up being incredible buying opportunities. But this time feels different because of how much damage was done in such a short period. The S&P 500 and the Nasdaq are now both negative for 2026. The S&P is down 0.7% for the year, and the Nasdaq has dropped 1.2%. These January losses erased all the gains we had built up in the first few weeks of the new year. Treasury yields spiked to their highest level since August on the 10-year and September on the 30-year bonds. When bond yields go up like that, it means mortgage rates and personal loan rates are going up too, which puts more pressure on consumers. And then there's what happened with gold. Gold absolutely exploded to the upside. On Monday, January 19th, gold broke above $4,600 per ounce for the first time ever. By Wednesday, January 21st, gold hit a new all-time high of $4,188 per ounce. That's a 73% increase compared to the same time last year. Gold is up 8% just in the first 3 weeks of 2026. Silver also broke records, jumping above $95 per ounce. These are metals hitting levels nobody thought possible just a year ago. At the same time, the US dollar had one of its worst performances in a decade during 2025, and it's continuing to weaken in 2026. The dollar dropped as investors started fleeing US assets. One Danish pension fund, Academic Pension, even announced they're completely exiting US treasuries because of concerns over US debt and the chaos around these tariff threats. When a foreign institution stops buying American government bonds, that's a red flag. The Fear and Greed Index, which measures market sentiment, swung hard into extreme fear territory. The VIX, which is Wall Street's fear gauge, spiked to very high levels. People are scared. And when people are scared, they make emotional decisions. They sell when they should be buying. They panic when they should be planning. But here's what you need to understand. The European Union is the largest trading partner with the United States. We buy more stuff from the EU than from Mexico and China combined, and they buy massive amounts of products from us. So when Trump threatens 10% tariffs that could go to 25%, that makes doing business with Europe more expensive. American companies that import goods from Europe will pay more, which either cuts into their profits or gets passed on to you as higher prices. European companies that export to the US will sell less because their products become more expensive here. And in response, the EU has already talked about retaliatory tariffs on American goods, which means European countries will buy less from US companies, hurting those businesses and their stock prices. So why should you care about all of this? Because it directly impacts your money, your investments, and your buying power. When we're talking about trade wars with our largest trading partner, we're not talking about some abstract economic theory. We're talking about real consequences for real people. First, let's talk about what this does to companies. When tariffs go into effect, American companies that rely on European imports suddenly face higher costs. Maybe you're a company that imports German machinery or French pharmaceuticals or Italian luxury goods. Those costs just went up 10% or potentially 25%. Now that company has two choices. Either absorb those costs, which crushes their profit margins and hurts their stock price, or pass those costs on to consumers, which means you pay more for products and the company sells less volume. Either way, the company gets hurt. On the flip side, American companies that export to Europe face retaliatory tariffs. So if you're Boeing selling planes to European airlines, or you're a tech company selling software to European businesses, or you're a manufacturer shipping industrial equipment overseas, those European buyers are now facing higher costs on your products. They're going to buy less. Your revenue drops. Your stock drops. This is why the market sold off so hard. Investors are pricing in lower profits across the board. Now let's talk about the dollar, because this is where it gets really interesting. Our dollar is not backed by gold. It's not backed by anything physical. It's what we call a fiat currency, which means the value of the dollar depends entirely on other people's belief in the strength of the dollar. We have an advantage because the US dollar is the world's reserve currency. Most international trade happens in dollars. But when you see chaos like this, when you see threats against allies, when you see foreign pension funds dumping US Treasury bonds, that shakes confidence in the dollar. And in 2025, the dollar had its worst year in about a decade. It lost value relative to other currencies and relative to assets like gold. When the dollar weakens, that has real consequences for you. If you're buying imported goods, avocados from Mexico, electronics from Asia, cars from Europe, you need more dollars to buy the same amount of stuff because each dollar is worth less. That's inflation by another name. Your buying power decreases. 5. On the other hand, a weaker dollar can be good for American companies that export products because their goods become cheaper for foreign buyers. But here's the problem. If those foreign countries are hitting us with retaliatory tariffs at the same time the dollar is weak, it cancels out that advantage. They're less likely to buy from us anyway because of the tariffs. This is where real diversification becomes critical. And I need to be clear about what real diversification actually means, because most people get this wrong. When I talk to investors, they tell me they're diversified because they own a growth fund, an international fund, a blue chip fund, maybe a small cap fund. That's not real diversification. That's diversification inside the stock market. All of those funds are still stocks. When the stock market crashes, all of those funds go down together. Real diversification means spreading your money across different asset classes. Stocks are one asset class. Real estate is another. Precious metals like gold and silver are another. Cryptocurrency is another. Startup investments are another. Each of these asset classes moves differently during different economic cycles. When stocks crashed this week, gold hit all-time highs. Real estate prices didn't move at all because real estate moves much slower than stocks. If all your money is in the stock market and the market drops 20%, your entire portfolio drops 20%. But if your money is spread across stocks, real estate, gold, and other assets, you have protection when one sector crashes because other sectors might be going up. Let's dig deeper into what's happening with gold because this is one of the most dramatic rallies we've seen in modern history. Gold just hit $4,188 per ounce on January 21st, 2026. That's up 73% compared to where it was a year ago. It's up 8% just in the first 3 weeks of this year. And experts are now predicting gold could hit $5,000 or even $6,000 per ounce in 2026. Now, I've been investing in gold for a while, since before the pandemic, before it was cool. And I need to be clear about something. Gold is not a huge piece of my portfolio. It's a small piece. Because the way I look at gold is as insurance. It's a hedge. It's protection against what I call doomsday scenarios. Here's the thing about gold. When you invest in gold, that gold doesn't do anything. It doesn't produce anything. It doesn't have economic value in the way other assets do. Other metals like silver and copper, they're used in our economy. You use them in construction and electronics and manufacturing. There's actual utility there. But gold just sits in a drawer and looks back at you. It's shiny, but it's not producing cash flow. It's not building anything. So why do people buy gold? They buy it because they're concerned about the dollar. They buy it because they're worried about something bad happening in the economy. And if you look at history, there have only been a few periods where gold prices grew faster than the stock market. The Great Depression. The early 1970s, when we had stagflation and massive inflation problems. The 2000 dot-com bubble bursting. The 2008 financial crisis. The 2020 pandemic. And then it happened again in 2025. And now with these new tariff concerns, gold prices are booming again. When you see gold breaking records like this, it's telling you something. It's telling you that investors are scared. They're moving money out of stocks, out of bonds, and into something they view as safe. Gold topped $4,106 on January 19th during the Martin Luther King holiday when U.S. markets were closed. By the time markets reopened, it kept climbing. The rally is being driven by what investors call safe haven demand. When geopolitical tensions rise, when there's uncertainty about government policy, when there are concerns about the independence of institutions like the Federal Reserve, people flee to gold. Silver is doing something similar. Silver jumped above $95 per ounce, recording gains of 10% in a single week and up 33% since the start of the year. Silver is different from gold because it actually has industrial uses. There's strong demand for manufacturing, from solar panels, from electronics, but it's also benefiting from that same safe haven rush. Now, analysts at major banks are putting out some wild predictions. Goldman Sachs is forecasting gold could hit $4,900 per ounce. The question is, why is gold surging right now specifically? It's not just the tariffs. Multiple things are happening at once. Central banks around the world are buying massive amounts of gold. They're diversifying away from the dollar. They purchased over 566 tons of gold per quarter in recent data. The Federal Reserve is expected to cut interest rates twice in 2026, which makes gold more attractive because when rates are low, the opportunity cost of holding gold goes down. Gold doesn't pay you interest. So when savings accounts and bonds are paying less, gold becomes more competitive. And there's the geopolitical uncertainty. The Greenland crisis, tensions with Iran, the situation in Venezuela earlier this month, all of it is pushing investors toward assets they view as stable. So what does all of this mean for you as an investor? Here's the reality. Volatility creates opportunity. When markets are going down, good investments go on sale, but you have to be able to separate emotion from strategy, and that's where most people fail. We've seen huge gains in the stock market over the last 3 years. Could we see a correction from here? Absolutely. Could we see a recession? Absolutely. Does that guarantee we're going to see a recession? No. We don't know what's going to happen. But as a financially savvy investor, downturns create opportunities for you to buy good investments at a discounted price. The key is you can't get caught up in the day-to-day noise. The mistake most people make is this. They tell you they're investors. But the second something bad happens in the market, they immediately become traders. They panic. They freak out. And instead of buying low and selling high, they end up buying high and selling low. You don't need to be a math genius to know that buying high and selling low is not a recipe for making money. Think about it this way. When you see headlines about market crashes and you see your portfolio value dropping, your brain is screaming at you to sell, to get out, to protect what you have left. But that's the exact moment when smart investors are buying. Warren Buffett has a famous quote, "Be fearful when others are greedy, and greedy when others are fearful." Right now, the fear and greed index is showing extreme fear. That means opportunity. Now let's talk about how you actually build a portfolio that can handle this kind of volatility. You need real diversification across different asset classes, and each of those asset classes goes through its own cycle. Our economy goes through cycles. We go through booms and busts. Recessions are part of our economy. Economic booms are part of our economy. But we also go through asset cycles. Real estate goes through cycles. We've seen real estate prices boom, crash, and boom again. The stock market goes through cycles. We've seen the stock market have incredible runs, then crash 20%, 30%, 50%, then come roaring back. Cryptocurrency goes through massive cycles. Bitcoin went from $1,000 to $20,000, crashed to $3,000, went to $69,000, crashed to $15,000. When all of your money is in one asset class, you are subject to the big swings up and down within that one asset class without having protection across different asset classes. This week, the stock market crashed. But nothing really changed in the real estate market because real estate prices move much slower. You can't panic sell a house the way you can panic sell a stock. Gold prices went up as stocks were going down. This is the beauty of true diversification. Let me break down what real diversification looks like. You want paper assets, that's your stocks, your ETFs, your index funds. You want hard assets like real estate, which gives you cash flow from rent and appreciates over time. You want some speculative assets, maybe you're investing in startups, maybe you're in crypto. You want protectionary assets like gold and silver that act as insurance when everything else is falling apart. When you spread your money across these different asset classes, you're not just protecting yourself, you're also creating opportunity through different economic cycles. Here's an example. Let's say there's a recession and the stock market drops 30%. If you're 100% in stocks, you just lost 30% of your wealth. But if you're diversified and you have gold, your gold probably went up during that same recession. If you have real estate generating rental income, that income is still coming in. If you invested in certain startups or you're holding Bitcoin and it's in a bull cycle, those might be going up while stocks are going down. You're protected on multiple fronts. And here's the opportunity side. When the stock market crashes 30% and you have cash or you have assets you can sell, you can now buy those stocks at a 30% discount. That's how wealth is actually built. You buy assets when they're cheap, you hold them while they recover, and you sell when everyone else is excited and prices are high. Your goal as a long-term investor needs to be focused on three things. Number one, understand where money is moving. What sectors are getting investment? What's the Fed doing with interest rates? What's happening with inflation? Number two, find what it is you want to invest in. Do your research. Understand the companies, the real estate markets, the assets you're buying. And number three, come in and buy at a good price. When markets are going down like they did this week, that creates an opportunity to buy good investments at a discounted price. But you have to know your strategy. What's right for me may not be right for you. Maybe you just want to invest in the S&P 500 through an index fund and call it a day. Great. When markets go down, that's a great opportunity to buy more. But as a long-term investor, you've got to be able to hold your emotions in check. You've got to be able to see past the fear. Following section 8, what to watch next? 1330, 1430. So what happens from here? That's the big question everyone's asking right now. We have this so-called framework of a deal between Trump and NATO over Greenland and Arctic security. But what does that actually mean? Trump called it the concept of a deal, which is pretty vague. He said it's a long-term deal, the ultimate long-term deal, but he wouldn't confirm whether the US is actually acquiring Greenland or not. Denmark's foreign minister said the day is ending on a better note than it began, but he also urged parties to sit down and address American security concerns in the Arctic while respecting Denmark's red lines. Some European leaders are cautiously optimistic, but others are warning not to celebrate too early. Germany's finance minister said it's good they're engaged in dialogue, but there's still a lot of uncertainty. The bottom line is, we don't know if this framework will actually turn into something concrete or if it's just talk. Here's what you need to keep an eye on. First, watch what happens as we get closer to that original February 1st deadline. Even though Trump said he's not imposing the tariffs now, will he threaten them again if negotiations break down? We've seen this movie before. Trump threatens, markets crash, Trump pauses, markets rally, then a few weeks or months later it happens, all over again. Second, there's a wild card that most people aren't paying attention to. The U.S. Supreme Court is reviewing whether Trump even has the legal authority to impose these kinds of country-specific tariffs without Congress. During oral arguments, justices have expressed skepticism about the extent of presidential power here. If the Supreme Court limits Trump's tariff authority, that could completely change the game. Markets would likely rally hard on that news because the threat of sudden tariffs goes away. Third, watch the Federal Reserve. The Fed is expected to cut interest rates twice in 2026, according to current projections. Rate cuts are generally good for the stock market because borrowing becomes cheaper and companies can invest more in growth. But rate cuts are also good for gold because the opportunity cost of holding gold goes down. If inflation stays sticky or starts rising again, that complicates the Fed's plans. Fourth, keep an eye on the dollar. If the dollar continues to weaken, that has implications for everything from import prices to export competitiveness to gold prices. A weak dollar makes U.S. exports cheaper for foreign buyers, but it also makes imports more expensive for American consumers. And if foreign institutions keep selling U.S. Treasury bonds like that Danish pension fund did, that puts upward pressure on interest rates, which makes mortgages and loans more expensive. And finally, watch the pattern. In 2025, we saw this exact cycle 3 times. Tariff announcement, market crash, tariff pause, market recovery. The S&P 500 ended 2025 up over 16%, despite 3 separate crashes at the beginning of the year. Those crashes were incredible, buying opportunities for people who kept their cool. Will this be a repeat of that? Maybe. Or maybe this time is different. We don't know. What we do know is that, as an investor, your job is not to predict the future. Your job is to be prepared for multiple scenarios and to position your portfolio so that you can win no matter what happens.